Hello, everyone, and welcome back to the Pulse here with the PeakBot team. You are joined by Dillon and Ben, co-founders and co-hosts. Excited to be back. I had to miss the show last week. We'll get into all that, but excited to be here. Excited to get into another week of trading. We are here to cover all things options selling, from exploration to automation. For those of you who may not be familiar with PeakBot, we are an automated trading platform for the retail trader, specifically in the world for options traders, making it easy, affordable, and transparent for the everyday person to put a stock trader in their pocket. So today we got a lot of things to go through, which we will get started on here in just a minute. As always, if there are questions, do not hesitate to ask. Throw them in the chat live. We're here to answer them for you. Or if you're feeling a little shy, that's okay too. You can text us on the number below. That is our business line. It rings to our whole team. Somebody will be there to help you with any questions you might have. And lastly, this is not financial advice. We're not financial advisors. We still got to get a hat or a mug or something. Maybe we'll talk to one of our partners.
You wear a hat every show, so you just need to put it right on your forehead.
There's room here. We got a blank canvas. By the way, Under Armour, if you're watching, which you're not, throw us some love.
Collab with Under Armour.
But Ben, I'll kick it to you. We can get into things. How you doing this morning?
I'm doing great. And by the way, Dylan's not just going to go out and say it, but he missed the show last week because he had a baby. Well, he didn't have the baby. His wife had a baby.
I did nothing compared to my wife. Yeah, thank you, Ben. We introduced had my first kid, a baby girl, happy and healthy, both mother and baby. Yes, exciting. Little tired. But, honestly, I was telling Ben last night, got a pretty good night's sleep. Got about 2 hours at a time, 3 different times. I mean, that's a lot of people's. That's a full night's sleep for a lot of people. Now, a lot of poopy diapers in between, but neither here nor there. But the good news is,
everybody's healthy. That's the first good news. I know where you're going with this.
Yes,
that's the first good news.
You're right. Okay, Ben is always there to prioritize me. The good news is everybody's healthy. The next best news is, while I've been adjusting to life at home with an expanded family here, I've been trading hands-free the whole time with PeakBot. I couldn't help myself. In fact, I just looked at my Tradier account this morning for the first time, honestly, since like Monday or Tuesday of last week. And things are going well. We'll get into that. I'm collecting premium like a madman, as always, running the trend spread strategy. Got the Iron Condor going, which, again, we'll talk more about those strategies today if you're not familiar. And if you have questions, ask. But Ben, what do you say we get started? We can take a look at our watch list. And maybe you probably mentioned this last week with Thomas took my seat, right?
Thomas filled in. Yeah.
Young Thomas.
Thomas wasn't the smoothest fill in, but
oh, you know what? I'm glad you said that. Thomas, if you're watching, step it up. But let's get into the watch list, Ben. So maybe pull up your screen and maybe worth mentioning, yes, this watch list looks a bit different. First of all, you can view this watch list at usepeakbot.com/watch lists. But Ben, not for very long, right? I mean, it's still public now.
Yeah. So we're in like a middle ground, weird kind of area with our watch list at the moment. We've got our alerts watch list, which still needs to make their way over into the automation watch lists.
Yes.
So so what I have on screen, if you are subscribed to PeakBot alerts, and you can do that at alerts.peakbot.com, just $5 a week, you'll get access to this watch list. This watch list is a souped up version of our current watch list. And I'm looking at our credit spread watch list right now. We've got the Iron Condor watch list, and I'm getting the vertical wheel watch list on here this week. This watch list updates every 5 minutes, and that's different from our other watch list, which only updates every hour. So this is definitely more for manual trading. We built out PeakBot alerts for those that can't automate. And the only reason somebody can't automate with PeakBot would be you just don't have a brokerage account with one of the brokers that we're integrated with. And that's typically due to just a person's location in the world and what brokerages that they can create accounts with. But if you're in the US and you haven't tried our automations, you can create an account at Tradier. Go to usepeakbot.com/Tradier. Sign up for Tradier Pro. You're going to save a ton of money in commissions. It's $10 a month, but you're not going to have to pay a commission fee for every contract that you trade. So it's really beneficial. And when we get into some more results, we'll show how much we actually save. I think last week I saved, it was definitely over $100. I forget how much exactly though. But anyways, enough of that rambling. And we got on screen here. Perfect. This watch list that we've got up on screen here. Again, this is for our credit spread strategy. We called it trend spread because we are trading with the trend. And you can see here, we've got sell this put strike, buy this put strike, sell this call strike, buy this call strike. So we're blanking out the side that you don't want to sell. So I just filtered for the call strikes, or sorry, the put strikes. If you're looking at put strikes, it's a bullish trend. If you're looking at call strikes, it's a bearish trend. So we're doing that work up front for you. This list is filterable. So you can play with expected value, probability of profit, ROI, buffer. So you could play with all these things. The default is we've sort by expected value. If you wanted to look for just a certain company like Morgan Stanley, you could start typing the name in and then Morgan Stanley pop up. So really cool features compared to our other watch list, which tells you the trend and it still gives you both strike prices. We give you a risk level, which is something that we actually removed because risk is apparently kind of built into expected value. And there's just a different amount of data on this watch list. Still really good, and you can still use it to get your automations set up. But the new and improved watch list on the alerts page is awesome. And I will be using this to trade live today with Thomas at 2 p.m. Eastern, live on X and YouTube. So anybody joining us now, feel free to tune in again later. We'll be live trading together. Last week, and I don't want to brag too much, but I returned almost 12%. And here's my commission savings. So just by using Tradier Pro, I saved about $160 in commissions last week, which is fantastic. So I traded with $18,000 worth of capital. I went 9 for 9 on my picks. Pulled out about a $2,100 profit on the week. Again, only trading with 18 grand. And the real risk of trading with 18 grand is really, really low because we're trading around the 30 delta, which when we're selling gives us about a 70% chance of a win there. And you can actually see on our new watch list, we do have probability of profit built in. And you can see it's hovering right between 70 and 80 for a lot of these tickers. So join us live today, 2 p.m. Eastern. We'll be going through, I actually did open up some positions on Friday. So I've got some profit targets at 60% set for those positions. And we'll be getting into some more trades, myself and Thomas at 2 p.m. Eastern. So again, this watch list that we've got here for everybody for free right now, this is for our wheel strategy. The wheel strategy, if you don't know, and you haven't been on the show, is you start by selling cash secured puts, and we like to do weeklies. So we sell cash secured puts on a Monday, and then on Friday or at the day of expiration, if that position expires in the money, we will then get assigned those shares. And then when we do get assigned those shares, we'll sell covered calls. Now, at PeakBot, we actually like to change it up a little bit. We like to sell what's called the vertical wheel. So we sell a spread, and we do that because we want to cap our downside. So in the case of maybe you accidentally traded during earnings or there was just some bad news that came out, you don't want to be stuck holding the bag. You want to take a max loss. You want to take an insurance policy, we like to call it, and get out of that position. So we like to trade vertical, the vertical wheel, which is just we start with put credit spreads. We could still get assigned. if the stock price falls between the two strike prices. And then we will sell a call credit spread to get out of that position, to get those shares called away the next week or the week after, whenever that assignment actually happens. So that said, Dylan, I'm curious to know how. I mean, we saw how my positions did, but I was on top of these positions, taking profit at certain percentage points all week. I want to know how you did, if you got an analysis in front of you. If not, we can come back to it. But while you were taking care of your newborn baby, how did PeakBot do for you?
So you know what? Let's take a high level view of it. What we'll do is I'll pull up my screen here in just a second, and we will take a look at my PeakBot account, which tracks my premium earned. And then throughout the duration of this show, maybe I'll pull up a more sophisticated, more detailed version of the trade. So I'll go ahead and pull up my screen. What we'll see here is my PeakBot account again. And for anybody who's not familiar, you can visit us and get started with your automated trading here at app.usepeakbot.com. Okay, so check that out. In the last week, I'll zoom in here over to my chart here. You'll see in the last week, I've made $196. Okay, so not nearly the week that Ben had. Okay, now Ben was doing some manual trading. He was hands-on. I've been letting my account kind of just rock on autopilot. So what you'll notice here, and we'll take a closer look at the individual trade log. So let's go to, and that's actually not including my trend spread trades from last week. So if we take a look at trend spread, I've been trading a lot of the stocks that I've been rocking for the last few weeks here. So Alcoa Corp, CCJ, Chewy, which is a nice one, making a nice premium on that one. Took a loss on Intel. But you guys can see my whole approach here is continue to collect premium on stocks that I'm comfortable with and that I feel good about in the long run. Additionally, with the trend spread bot, which sells weekly credit spreads, okay, with the trend, meaning if we're looking at our watch list here, and I will zoom in before Ben tells me to do so. If we're looking at our watch list here, let's just take Datadog as an example. If it is trending bullish on our watch list, then the trend spread bot will sell a put credit spread. If it's bearish, like Intel, it's going to sell a call credit spread. And if it's neutral, like Exxon here, for example, it'll sell an iron condor. So me personally, again, not financial advice, I like to be spread out, no pun intended, in every direction I can, right? I like to have about the same amount of puts as I do calls. Right? If the market's just screaming and it seems like it's going to continue to do so, maybe I'll lean more so on selling puts. But a direction change in the middle of the week, a trend change in the middle of the week is really can get you, that's what can snag you. You can tell I'm tired.
That's how you lose.
That's how you get in trouble, right? So kind of having your spreads going in multiple directions is really helpful here. So just again, as an update, since May 1st, this account's up roughly 26%. So I'll share and you guys can go to our Twitter at usepeakbot to see exactly how this account's been performing with all the trade details and everything there. So slower week last week for me. If we take a look at the quarter, and by the way, this is on about a 16K account. I'm up about $773 in the last quarter on about 100 trades here. You guys can see I took some damage between June 21st, 25th. I'll take a closer look and maybe I'll throw it in the chat as to what trades really hurt me there. But look, steady flow. You guys can see how this has all been performing. So that's awesome. How I've been. Go ahead, Ben.
I was going to say that's awesome, especially for a week that you weren't really paying attention, taking care of your newborn, letting the bots do all of the work for you. Exactly. So we're about 15 minutes in right now. And I think it's time to introduce, we've got a special guest today. We've been posting about it on LinkedIn, on X. I know, so we've got, it looks like a little over 400 people watching us live right now. They're excited to learn about options, exercises, and assignments and how that works. I'm excited to learn about it. So I'd like to welcome into the studio Matt Cashman from the OCC. Matt, how are you doing this morning?
I'm doing great, gents. How are you guys?
Excellent.
Fantastic.
Thanks for coming on the show, Matt.
Yeah, man. I got a little time zone mix up. East Coast Central.
No worries.
And I apologize for being a litry bit late.
No worries. This works out perfect. We got our normal segment where what people like to see. They like to walk through our watch list with us. But Matt, if you wouldn't mind, you want to give a quick intro to yourself to just all the viewers?
Yeah, absolutely. So my name is Matt Cashman. I am the principal of investor education at OCC, which means I teach people how options work, essentially. OCC is the largest clearing corporation of options in the United States, actually in the world. So if you trade options, touch options somehow in the listed space, either indexes or equities, OCC touches that option somewhere along the line, usually in the pipes behind the scenes of what you're actually doing. So exercise and assignment, which we're going to talk about today, settlement, all of those things. Those are the parts that OCC takes care of behind the scenes as far as options are concerned. As far as I'm concerned, I've been a trader since 1999. I started trading in equity and index options on the CBOE, on the floor of the CBOE in 1999. I've traded a little bit of everything, but mainly index and equity options in the United States. And then I traded some German bond options in London. I lived in London for 3 years and traded there. And then I moved back to the United States and started an index options market making business and ran that for about a decade on the floor of the CBOE again. And then recently I transitioned to the position that I have currently, which is teaching people about the risks and benefits of exchange traded options for the OCC. So really what I do is I leverage all of that experience from all of my trading over the last 25 years or however long it's been now. And I use that to teach people how options work.
Fantastic.
Love it. You've got a lot of experience under your belt. And if anybody's got questions about options, go check out Matt's LinkedIn page, connect with him. Matt, how active are you on your X page? We could throw your handle.
I'm not as active on X as I am on LinkedIn. LinkedIn is usually where I do much of my what we call thought leadership now. But yeah, exactly. But I would like to be more active on X because I've heard a lot of people say that the actual what we used to call the Twitter fin space is like
FinTwit,
super active and very helpful. So I've been trying to think more kind of like bilaterally there.
Well, we'll help you where we can to get us going and get the brain juices flowing, Matt. We're going to see how much you know about the New York Stock Exchange. So I'm going to pull up my screen. We've got a little bit of trader trivia. Dillon, I'm going to make you answer the question too.
Yeah, please. Please.
These questions are meant to be a little obscure as well. So, no pressure. But the question here, as stated, is what was the first company listed on the New York Stock Exchange?
Jeez.
Yeah.
If you want to guess first, Matt, go ahead. If not, I can give you a little buffer. It's up to you.
And anybody that's watching, feel free to drop your guesses into the comments.
I'm going to say the Bank of New York.
I like that guess. I think it's, for me, it's a little too on the head. I'm going to go with D, Ford Motor Company. Final answer.
Ford Motor Company. All right. So Matt's got B, Bank of New York. Dillon's got D, Ford Motor Company. Everybody watching, feel free to throw your guesses into the comments here. Now, before we get to that answer, because we want to leave everybody in suspense, let's answer this would you rather question. So the question is, would you rather invest in a stock that promises steady dividends but requires you to read through a 100-page report every quarter? or trade volatile options that could double your money in a year, but might give you heart palpitations every time the market opens. So what do you value? Steady returns, or risking it for your health?
Oh my God. I don't,
I mean,
I don't know whether or not I can answer that legally. How about this? I'll answer this way. I would rather trade the options on the thing that's moving a lot more if I were very well informed and had read the options disclosure document like I'm supposed to be required by law.
So both there.
Yeah, I hate to do this. I have a similar answer where it's both, and sorry for Ben. I know you crafted this question, but
I didn't. ChatGPT did.
Oh, thanks, ChatGPT. So for me, anybody who knows us knows that I ain't reading a 100-page report on any stock. So that answer is out. However, I'm not the high risk guy either. I made 32% last year with my PeakBot account, and I was pinching myself, right? Thrilled. So for me, my answer would be I'd let PeakBot trade those volatile options for me, right? I would let PeakBot do it for me. I have defined risk. I'm trading my spreads. I'm likely trading with the trend. My answer would be the latter. And I'm not going to have heart palpitations. I didn't even know how to spell palpitations. I'm not going to let that happen because, great example, for the last week, I've been hands off trying to feed and keep a baby alive. I have some volatile options in my portfolio, and we'll get into that later in the show, but I'm not stressing about it. So my answer is the latter. I am very anxious to know the answer to Trader Trivia.
All right. We can move on to that.
Hit me.
All right. So the answer, drum roll, please. Bank of New York.
Oh,
you got it.
Matt. Oh, yes.
You got it.
Yes.
You got it. And fun fact. So actually, Matt, last week the question was around what was the first futures exchange, and it was in like some town in Japan. It was a rice exchange. So these questions are a bit obscure, but this is a fun fact. So the Bank of New York, first company on the NYSE in 1792. That was a long time ago. The market's been around for a while, longer than most people think, but in different forms.
Yeah, man. The interesting part about the Bank of New York is that it's still theoretically around, right? Like
BNY Mellon.
Yeah. Exactly. In part, and BNY Mellon actually does a lot of really interesting stuff in the crypto space. They're actually quite forward thinking as far as the way that they think about custody and things of that nature in the crypto space. It's pretty amazing.
Alexander Hamilton, did I see there?
Yeah, founded by Alexander.
He founded it. Yeah, he founded the Bank of New York.
Okay, wow, he's got more on his resume than I realized. So,
other than being the star of a Broadway show, right?
Yeah, wow.
Awesome.
So really quick, I just wanted to mention to Matthew Kennedy in the comments here. Good morning. How we feeling on MU ticker MU, which is Micron? I just don't want to leave him hanging for too long here.
Yeah, I was going to get to that because I've actually got Micron in my portfolio. I traded Micron on Friday, and I've got an open position. So I'll share screen here so we could take a look at it on the watch list. It's currently 1, 2, 3, 4, 5th down on the watch list. So Micron, interesting. And Matt, this will get us into, option exercises and assignments. But Micron has an ex-dividend date today. Inherently, the stock price will drop by the price of the dividend, but it's a small dividend. I think we looked it up on Friday when Thomas and I were looking into trading this. It's about 11.5 cents per share. So how much is that really going to affect a $132 stock? Not so much. So I did wind up taking the trade. I set up a credit spread, $6 wide credit spread. My strike prices, if I look at my Tradier account, are at the 128 put and a 122 put. So I am bullish on the position, and I've got my take profit set up for today. I've got an order for 42 cents to get out, which would land me at about a 60% take profit. So to, just to put it out there again, not financial advice, I'm personally in Micron. I don't think the dividend's going to have much to do with it and with the stock price. And then when we analyzed the ticker on Friday, it looked like there was some decent support. I could pull up the chart real quick.
Yeah, pull up the chart. I have the Tradier's technical analysis tool, which Ben will have on screen here in just a second. Looking good. The 1 month chart's kind of a little all over the place.
Yeah.
But Ben, check out the technical analysis really quick and then go back to the chart. So we like to move it to 1 week.
To a week.
I love that.
14 buy, 10 neutral, 2 sell. It's a little more neutral than I'd like to see, but hey, you could be neutral, you could be a little bit wrong on this and still walk away with a profit. So the thing that Thomas and I kind of concluded on when we were looking at this on Friday was we were selling the 128 strike, and there was a bit of support here last week on that. And then if we zoom out a bit, there's a certain amount of consolidation between that price level, which made us feel a little bit more comfortable when we were about to take the trade. So overall, of course, do your own due diligence. Thomas and I both decided getting into a position in Micron was good for us. And we did take that position. And of course, I've got my take profit orders already plugged into my Tradier account. So hopefully that helps. If you have any follow-up questions, Matthew, feel free to put them in the chat and we will get to those. But I did want to get to, and I mentioned that Micron has an ex-dividend date today. And if you're selling, and Matt, this is typically what happens to me when I get assigned shares randomly in the middle of a week and non-expiration, right? It's typically because a company is reporting or they have an ex-dividend date and somebody on the other side, right, is wanting those shares. So if I've got a short call position, then I'm going to have to give my shares away if I've got those shares, right? So, and it happens randomly. Like Dillon, we were talking about this a couple weeks ago where I got my shares called away and you didn't. And it was just kind of random. So Matt, maybe we could get into a little bit of how that actually works and how is it decided, like who gets their shares taken away and who doesn't?
Yeah.
Who's the matchmaker? Yeah.
Is it you, Matt?
Matchmaker, make me a match. So the interesting part about this that you have to, let's start from the very beginning of like how the options actually work, right? If you're long options, you maintain the right to exercise your option. That's what you're paying for when you buy it. That means if you're short that option, you are incurring the obligation to make that option whole, right? To make the other person whole if they decide to exercise. Mm-hmm. So what you have is the process by which the exercisees, the people who are exercising, are sending what we call exercise advice from their seat through their brokerage firm. The brokerage firm then has a relationship with the clearing firm, which has a relationship with OCC. I want you to think about OCC kind of like as the central clearinghouse for all of these things. And all of these member firms are coming into OCC and have relationships there. Once those exercise advices come in, right? These are people saying, I want to exercise my option. Those are people that are long the option. They come in through one channel. There's I think it's like a 23-point random algorithmic process by which the buyers, the people who are exercising options, and the people who are short the options, then get assigned, right? You get matched up at the clearing level with someone who's exercising the option and someone who is short the option. And then what happens is that gets matched up randomly through some random algorithm.
Completely
random at the clearing level, right? At the OCC level. Now, also keep in mind, at the OCC level, OCC does not see anyone's account or who's attached to any of these accounts. By the time those accounts are at the OCC level, they've gone through, remember, your relationship is with your brokerage firm. Your brokerage firm has a relationship with their clearing firm, and the clearing member firm has a relationship with OCC. So from OCC's perspective, they're just saying this clearing member and this clearing member are getting matched up. This person wants to exercise. This person wants what needs to be assigned. So it comes in as an exercise. It gets matched. it goes out the door as an assignment that's been randomly assigned to
Mhm.
another clearing member firm, right?
Okay.
Then once it gets to the clearing firm level, the clearing firm, generally speaking, has its own random algorithm as to, okay, I have an assignment that's coming through the pipes from OCC. Who of my clients am I going to give this assignment to? So then there's a random algorithm there that matches up their clients with the actual assignment that's coming in. And then that goes down to the brokerage firm. The brokerage firm then has another, right, random level of assignment to figure out who sitting in their seat in their like home office or wherever actually gets assigned.
That's a crazy process.
That is a crazy process. But the interesting part about that is that many times people will send us questions about like, how do I know whether or not I'm going to get assigned? And
Yeah.
as you can tell from the way that that process is designed, the actual answer from our perspective is we assign. Yeah. I mean, it's kind of a shrug because of the fact, and it's not because we're not, on top of what's happening. It's because we're not assigning individual people's positions. We're assigning a clearing member firm who has an aggregate position, right? Let's say in the stock we were just talking about, Micron, right? There's however many positions that are open in that. And if you're a clearing member firm, you have lots of brokerage firms that feed into you. And the brokerage firms have lots of positions that exist at their customer level. So there's all kinds of people that are short the 128 puts, right? Yep. And some of those people are going to get assigned, but it goes through 3 like random processes in order for each person to be assigned, which makes the answer to that question hard to give, right? Like, how do I know whether or not I'm going to be assigned? I mean, we're assigning the actual clearing member firm, so we actually have no idea who's actually going to get assigned post that process.
So for anybody that's wanting the quick answer to this, the answer is it's random, right? You just you don't really know. It's random. So don't feel bad if you get assigned. You didn't do anything wrong, right? No. If you got paired up, pre-expiration date, there's nothing that you did wrong on your side. It's just a random process that you just happen to get selected. So Dillon, a couple of weeks ago, I was one of the lucky ones that got my shares taken away, and you held on to them. So Matt, are there ever any instances where when expiration date comes and you're holding a contract that's in the money, let's say you're a short contract that's in the money, where you don't actually get assigned shares or get your shares called away?
Ooh, this is a good one. I like this. I like this question. And for the answer to this question, I can draw on a couple of different pieces of like different scenarios that I've been in personally, but more specifically, let's start with the actual theoretical process, which is, and the answer to that is 100% yes. You can, what we call in the business, we call it skating, right? You skated on exercise or skated on being assigned. What that means is that you are short a contract that theoretically should be assigned, right? It is, if you look at it from the other person's perspective, the person who's long it, you would think that they are financially incentivized to actually to exercise their contract. And so, if the contract has like 100 delta, you're thinking, of course, I'm going to be assigned on this because no one would go and not exercise their contract. Sometimes it happens, and the reason why sometimes it happens is that sometimes people aren't paying attention. I mean, that's the actual like where the rubber meets the road in that situation is that sometimes people aren't paying attention. Let me give you a really quick story about this. In like 2003, 2004, I was trading Boone Bobble Shots options on the Eurex, right? Boone Bobble Shots is the German Boone Bobble and Shots, which is the 10-year, the 5-year, and the 2-year bonds.
Dillon liked that name, by the way.
Boone Bobble Shots. So here's a quick allegory. We were short a significant amount of in the money call spreads. And when I say significant, I mean like, 100,000 of them. I was
Wow.
working for a very big firm, and we had like 35 to 40% of the open interest in the entire product. At that time, at expiration, you had to manually exercise all of your long contracts.
So it wasn't automated.
It was not automated. And there was a GUI that you had to interface with the Eurex through the actual exchange.
Okay.
And so, as you can imagine, exercise and assignment was extremely stressful when you're dealing with contracts that are like 100 or 200 ticks in the money, because they're massive contracts, right?
Mhm.
Each contract is worth like 40 grand or 50 grand. And so we had 100,000 of these or something, and the exercises and assignments would come through the GUI, and it would say, you've been assigned on, 74,625 of this line that we were short. Well, we were short like almost 100,000 on that line. And so what that means is you skated on 25,000 of these contracts.
Wow.
But what that also means is that you're short these deep in the money calls, and you are long, right? Like option, you're long deltas against them.
Yep.
You're long actual underlying deltas against them. So what do you have now? Well, you have a bucket load of cash that just appeared on your doorstep, and then you have a lot of futures to sell, right? Because the option deltas were being held against the underlying deltas, and now the option deltas are gone, but the underlying deltas are still there, and you're long underlying deltas. So we had a ton of futures to sell. It turns out, long story short, the person who was long all of those 25,000 call spreads went to the pub on expiration day and did not exercise the long leg of his customers.
No way.
He needed PeakBot. He needed PeakBot the whole time. I hope it was a good round of beer he had.
Well, what it turns out is that it was a really expensive round of beers, right?
Yeah.
Because
good for you.
Yes, but right. Also, you have to understand that, like, in a situation like that, in an electronic trading environment like that, you have no idea who your counterparty is.
Right.
So, like, back in the day, if that happened, you would call the person and say, like, oh my God, mate, I forgot to exercise these calls, blah, blah, blah. There's no calling anyone. No one, like, there's no counterparty that anyone knows about. And so, long story short, right? That's a very long story. It's a very long explanation for this. But the reality of the situation is sometimes in the money contracts don't get exercised because people forget to exercise them.
Damn.
Now, in the United States right now, we have what's called it's called X by X at the OCC level. Exercise by exception. What that means is that in contracts that are generally in the money by a certain threshold, usually the threshold is 0.01 or 1 penny, most of these contracts are automatically exercised. And that means, and what X by X means is that you're going to be exercised at the point of expiration unless you tell us you don't want to exercise the option. And sometimes people don't want to exercise those options. And so that's what X by X means. And if you ever see a contract that you have on that you're being notified that the actual contract has been removed from X by X, what that means is that the contract specs have either changed or there's been a corporate action that has made things, different than every normal contract. And what OCC has done is it's removed that contract wholesale from the automatic exercise process. And now you have to make the decision as to whether or not you're going to exercise, even if it's about to expire.
And Matt, we actually just had a question texted in on the statements you're making now. And then I know we're coming up on time here, so we'll probably move into the final segment here. But the question is, why would somebody not want to exercise a position that's in the money?
Well, sometimes people don't want to actually hold the underlying or can't hold the underlying, right? I mean, like, sometimes people have option only positions and they cannot hold the underlying legally. There's a situation like that happens. And in that situation, very, very, very seldom, right? That story that I gave you is like crazy, right? Like that almost never happens because people are so financially incentivized to actually exercise when they're in the money. But you can certainly get situations where things are just barely in the money, right? By 1 penny or 2 pennies or whatever. And sometimes people look at the process of exercise and see that like exercising this is going to cost me X amount of dollars, right? To convert this into a stock position. And I'm only really buying or selling the stock a penny or two below where the free market is trading, and it's not worth it.
Not worth
And so
it. Yeah.
sometimes people make that decision as well, right? Like everyone is working in their own theoretical financial best interest. And so it's hard to actually get in the mind of someone else who's doing it because you don't know what their situation is, like whether or not they're allowed to own stock, whether or not they're, I mean, there's all kinds of things, like how much does it cost them to go all the way from option into an actual underlying position? It may be very costly for their position, right? For their actual their account.
Makes sense. No, that's a really good answer. So we've got a few really good answers from you today, Matt, in terms of assignments, and it's random, right? Random, nothing to feel bad about. You didn't do anything wrong. It's a random process. If you're in the money, you could skate by and you could, just nothing happens, right? And you get to, in our case, in PeakBot's case, the way that we trade, we would just collect our premium if we're in the money. Nothing else happens. We just take that premium home and we're good. And then finally, there are reasons why somebody might not want to exercise, and that could lead to skating by, right? If somebody on the other side doesn't want to exercise, they could skate by. So Matt, your life is options, right? It's basically that is your life. So what are the most commonly traded option strategies? And at PeakBot, we trade a lot of spreads, but we know that there's a ton of strategies in the market. From your point of view, what are the most commonly traded strategies in the market?
Yeah, it's a good question. The most, I would say by far the most common strategy that people employ, especially when they're starting out, are covered calls. The reason why that exists and the way that it does is because it's a natural progression, a natural outgrowth of being long equities. And almost everyone who is playing in the actual United States equity market starts from being long equities. I mean, like there's not a lot of people that like their first trade is selling short, like Tesla stock on margin, right? That's not usually how people enter the marketplace.
Right.
Usually the way people enter the marketplace is they have a 401k that they've been dumping money into blindly for the last 10 years, and they just happen to be long all of this whatever stock, right? Against that legacy underlying position, right? Long stock, it's a natural outgrowth to be able to sell calls against it. Lots of people think about it as like harvesting premium against something that you own anyway. And if you pick a strike that's above the market where you would theoretically want to be selling the stock anyway, then you're perfectly fine to get called away, right?
Yeah.
If your short option gets assigned and you have to fulfill the contract and deliver the shares to the person who's actually exercising, you're like, all right, well, I wanted to sell the thing at 200 anyway. Right.
Right.
So that I would say is number one. Number one thing that people do, especially when they're starting off, is selling calls. There's a secondary part of this, which is the kind of like flip side of that coin, which is leveraging a long stock position and wanting to have an actual out to the downside, wanting to have a protective level.
Like an insurance policy.
An insurance policy. I don't usually use that word for legal reasons, but since you said it,
since I said it,
since you said it, yeah. And we call those protective puts, right? They're downside puts. If the stock's trading 200, and you bought it for 175, maybe your kind of like mental stop is like 170, and you're up, $25 on the stock, and you want to have an out to the downside. So what do? You spend a little bit of money and you buy the 170 put against the long stock position. You do it enough times that if the stock trades below 170, you can exercise your put and you theoretically get to sell the stock at the strike price. That's how downside puts work. And so that's kind of like the second most popular strategy, I would say, within, the elementary strategies as far as that's concerned. Being short calls to the upside and being long puts to the downside. Now, on top, yeah, go ahead. You're going to ask a question.
No, I'm good.
Oh.
Keep rapping, man.
Okay.
This is great.
So those are the two things that are really very common.
Yep.
When you move on from that, you get into what you guys are doing at PeakBot, right? Which is spreads most of the time, right? You're trading spreads. The reason why, I'm sure you guys have talked about this ad infinitum, defined outcomes, and they actually offset each other, right? The premium that you're buying versus the premium that you're selling is an offsetting feature of the trade, which allows you to generally enter a trade like that. It gives you a defined outcome that is a little bit cheaper than if you were to, for instance, buy or sell the outright option, just one of those options, right?
Yep.
So that's the next part of that, where people essentially take that idea that we just talked about, being short calls to the upside against an underlying stock position or long puts to the downside, and then they extrapolate that out into a spread trade, which sometimes can be both of those things. It can be long puts and short calls, which we call a risk reversal or a combo. It can be being short a call spread instead of just straight calls. Or in many times, people like to use spreads when they're buying options because it's a cheaper way to enter a theoretically long optionality trade. And so instead of buying outright puts, which might cost you $5, you buy the put spread down there, like in the situation I was talking about. You might buy the 165.70 put spread instead of the 170 puts outright. And if you're buying the 65.70 put spread, that might cost you $2 or $1.50 instead of $5 for the actual put. So that's kind of how that evolution works most of the time when people start to understand how these actual options work and the optionality that's inherent within them. Then you get into more complex spreads, right? Which are condors, butterflies, call 1x2s, put 1x2s, ratio spreads, things of that nature. Once you get into that part of the option trading ecosystem, I think it's really important that people start to understand. I mean, I think it's important that people understand the underlying optionality all the time. And that's right.
Course,
that's my mandate. That's my job.
Right.
But it's particularly important when you're dealing with complex spreads that have more than one leg, right? Sometimes 2, 3, 4 legs, but then also have what we call embedded leverage within them, right? Which means if you're doing ratio spreads, 1x2s, 1x3s, like butterflies, which are 1x2x1, or condors, which are 1x1x1x1, right? Things of that nature. You need to start to really dive into how does this spread actually work? How does it perform with the stock here? How does it perform if the stock is up 4 standard deviations? How does it perform down 4 standard deviations? Like, start to think about how this spread actually works. Don't just blindly say, oh, like the Twitter sphere is alive with 1x3s in whatever, right? Like it's obviously a do, right? That's not how you should be really thinking about it. So that's my kind of like very long-winded explanation of how people generally, where we see people generally entering the market, and how I think about the evolution of how people generally trade.
That's interesting that you bring all that up in that progression as well, because Dillon, as we're talking to our clients too, we typically get interest from people that are doing exactly what you said is like stage one, Matt. Like they've got a retirement account, they're selling covered calls on these hundreds or thousands of shares that they own in company, whatever, and they want to earn a little bit of extra dollars and generate some income that way. So that typically is who we talk to at first, and they're like, hey, I want to get more involved in like spreads and like do a little bit more with their money. But great, fantastic answer. I know we're 10 minutes till the bell right now, so Dillon, I want to know, you got anything to wrap us up?
Nothing crazy, but Matt, obviously incredible feedback. Well, not feedback, incredible input and knowledge there. Look, to our audience, we have almost 800 people watching us right now. knowledge is power, right? Our whole thing and our saying is educate, automate, elevate, right? From the world Matt comes from, education is everything, right?
Yeah.
The more you know, the more comfortable you'll be with your trades, the less emotional you will be, right? We all know 90% of retail traders fail because they let emotions like fear and greed get in the way. That's why we started PeakBot over 4 years ago, to limit those emotions, save time, and for every other reason, right? So no, I don't have anything necessarily hard to follow that up. For people who know, me and my role in PeakBot, I'm the layman of the group, right? So no, this is incredible. I learned a lot here today, including the fact that Alexander Hamilton founded the Bank of New York.
Amen.
But no, Matt, we really appreciate you having us on.
This is awesome.
For our
Let me
viewers,
can I make one?
Yeah.
Can I make one quick aside?
Please.
And when you're talking about the fact that education helps you in the automation part of this, right? If PeakBot and the reason why people are using like programs like PeakBot is to try to remove the actual emotion from their trading, right? One of the best ways, just like you said, to actually reach that goal, not only through automation that you guys are talking about, but also through understanding how the actual baseline option contracts work.
Yep.
Right. Mm-hmm. Because if you understand how they work, you don't need to freak out about what's going on, because you understand the actual underlying math of why is this option contract doing what it's doing. And the more you understand that, right, I think it's kind of two ways to get to the same goal, right? And if you can use both of them at the same time, something like PeakBot that allows you to automate, that's great. But also understanding how the actual contracts work, you're using two lanes going in the same direction that are going to get you there even faster. So understand how those options work. It's a very important.
Absolutely. Well said. And I mean, that's what we're going for at PeakBot, right? We want people to understand. That's why we publish our strategies down to the very last detail. You can go look it up on our website and see all the strategies that we trade, exactly how we trade it. Trade them manually. We encourage you to do that. And then once you decide that you don't want to trade manual anymore because you just can't get it in at the right time, or it's just too much to mentally take, then use PeakBot. That's where we come into play. Yeah.
And for anybody watching, go check out theocc.com, right? You can go click on their education tab. There is endless amounts of knowledge for investors and traders out there, from the basics, your 101 level stuff to everything you can imagine. So Matt, we really appreciate you coming on here today. Incredible stuff. For anybody who was just tuning in, didn't catch the whole show here, the show's saved live on our social channels. You can find this on the Tradier Hub, of course. Thank you to our partners at Tradier. You can find this on our Twitter or X, whatever the heck you want to call it, and our YouTube channel. So appreciate everybody tuning in. Best of luck this week with trading. Catch Ben and Thomas today at noon, or no, 2. Catch Ben and Thomas live trading today at 2 p.m. Eastern on Twitter, Instagram, etc. And Ben and I will be live tomorrow to take a look at last week in review, how PeakBot traders have been performing, and a closer look at our personal accounts as well. So, Matt, again, thank you very much. Best of luck to everybody this week. And as always, we will see you at the peak. Take care, everyone.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.